My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people want to make friends. I'm just trying to save you some money. My job is not just to entertain you, but to educate and teach you. Coach, too. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. The Fed's tired of keeping interest rates low. The economy's too strong, too hot, too much easy money. So it's time to tighten, maybe tighten hard. Or in plain English, if you believe the Federal Reserve plays a big role in the direction of the stock market, and it does, you won't like the minutes they released today because it's clear they want to hit the brakes on the economy. Hence the harsh declines this afternoon, and then the Dow closing down 393 points, S&P tumbling 1.94%, and the Nasdaq plunging 3.34%, the worst since February of last year. Now, I don't think these minutes signal that we're about to have a repeat of the fourth quarter of 2018, when a new Fed chief came in and threatened to hit us with 3 rate hikes in a row, lockstep. These are just minutes. They're not policy, not even transcripts, just a debate among Fed officials about what to do. And Jay Powell is now a lot more cognizant of the power of his own words, unlike back then when he was a rookie. But it's clear the Fed is no longer your friend. So what does this mean to us as we look for opportunities in 2022? Same thing I've been saying since Powell pivoted in November. Swap out of the still richly valued conceptual stocks with no earnings and swap into the boring, tangible ones with profits and dividends and maybe even buybacks. At these intense moments in the stock market, what I like to do is actually look at the indices in real time as the day goes on. When these minutes came out at 2 o'clock, you could see the Nasdaq got slammed. So here, I mean, there were some worries, but it was the really nasty stuff that was in the minutes was not in the market. This is when it got digested into the market. You could see the sellers feeling like rats from a sinking ship. Now, does this mean we're about to have our first real correction in ages? Or has the Nasdaq been selling off precisely because investors predicted we'd be hearing something like this from the Fed? And we're knee-deep into the sell-off. Honestly, I don't think this is what Wall Street was anticipating today. I mean, obviously it didn't, or else the market would have gone like this. The Fed minutes are more hawkish. Most people didn't believe that they'd not only taper their bond buying, they're now talking about finding ways to start selling bonds. So again, had it just been a garden variety minutes, it would have gone like this. It didn't. This shocked people, so it went down like this. Might do the same in the morning if any of the strategists get a hold of this and think, wow, maybe I'm too bullish. Remember, when the Fed sells bonds, that takes money out of the system, money that could have gone to finance growth in the economy and ultimately the stock market. Some of the actions suggested by the minutes are novel, but if you step back for the last couple of months, I've been telling you, please don't fight the Fed. Precisely because the really expensive price-to-sales stocks get hammered whenever the Fed tightens. It doesn't matter what they're doing. It doesn't matter whether they're doing orthodox rate hikes, something more unusual. This is what happens. You want to sidestep that decline. Now, look, if you really like these stocks, just circle back at a lower level. Market's way too overbought, by the way, to think that we can just bottom right away, although some stocks will. In my experience, these incredible obliterations of growth stocks, they do end. In fact, they tend to end at the end of the third day today, and the best ones start bottoming as early as tomorrow. After all, these growth stocks have been pulverized since Powell's pivot in November, that it wouldn't be too surprising if the selling lets up sometime soon. So in other words, you can see that the market's going to open down again tomorrow. Hey, by the way, if the market opens up tomorrow, please don't get fooled. It will start going back down again. That's just scalpers who bought it right here, and they'll flip it right here. In my opinion, that's what's happened. So how should you position yourself, not this trading stuff, but how should you position yourself now that the Fed's serious about fighting inflation? All right, first, the companies with no earnings or big losses per share, in other words, the ones that are losing money per share, they can try to bottom. They even can try to bounce. But they have no real place in your portfolio right now because they're just not as good as their profitable peers with good balance sheets, many of which have come down big, especially in tech, and also have good growth rates. Now, I know there was negative chatter, say, about Salesforce today. Salesforce seeing its business slowing, but that stock's down more than $80 from its highs, including 20 points just today. It sells at 48 times earnings. Granted, that's not cheap versus the average stock, but it is not an average company. It's rarely cheap, and it looks a lot like past bottoms in this terrific tech company. Can it go down another 10, 15, 20 points? Of course. I started liking it at 8, all right? I mean, every time it got crushed like this, if I just said, ooh, I'm scared, think about it. How many times that would have been faked out? How about Meta Platforms, the artist formerly known as Facebook? That stock's down 60 from its highs. Now it sells for just 20 times earnings. What is it, a cereal company? 20 times earnings for one of the fastest growing companies in the world. That's a pretty darn attractive point. Palo Alto Networks, really expensive, down more than 65 from its highs, but it's doing spectacularly, although it sells at 70 times earnings. If that one drops another 35 points, I would pounce. So by 35 points, that's like a blink of the eye. Finally, you're getting a chance to get back into NVIDIA, which is very expensive, as always. But it's down 70 points from its high, sells at just 50 times earnings, had a great talk from the CFO today at a JP Morgan conference, and yesterday by a terrific gaming guy at CES. You know what? I'd say if the stock opens down, I'd start buying it tomorrow. There. Now, understand, I'm highlighting how far they've fallen from their highs, because I always hear people complaining that they bought at the high. They bought these high-quality tech stocks when they were flying. You're certainly not buying them at the high today if you bought them. Certainly not tomorrow if we go down again. You're buying them after they've been down for days and days and days, if not weeks and weeks and weeks. And even though they might be clobbered again tomorrow, well, you've got to pick your spot here. You can't act as if this was their first day down. The ones that don't make money, that are issuing shares that trade at multiples of sales, they're too hard for me, okay? You can try them. I have no idea when they're going to buy them. To me, that's not worth it. As for the tangible stocks, the stocks of companies that make real things and real money, they've now spiked. And I'm actually feeling a little less confident on a daily trading basis. I think those can come down a little. I'm getting more enticed by the profitable tech names that just got beheaded. Price does matter to me. So let me give you an example of what I mean by that. Nucor, okay, the great steel company, we own it for the Travel Trust. I've said over and over again that I like this company. No one else did. The stock was getting clubbed down to the high 90s again, low 100s. I told a CNBC Investing Club subscribers to buy shares in December after the stock had just been crushed, even though it reported very good preliminary numbers. Today, though, when the stock was up 7 in the mid-120s, we sent out a bulletin saying we'd peel some off if we could. We don't buy up 7. We sell up 7, particularly if the stock's up $20 before then. You know what that's called? That's called discipline. You want to buy into weakness and you want to sell into strength. Why I'm even thinking about buying, and why am I thinking about buying anything, right? If the Fed's no longer a friend, well, that's wrong. Aren't we supposed to not fight the Fed? No, that's wrong. You want to, when the Fed is fighting you, you've got to be more selective. First, let me give you some reasons. The Nasdaq is down huge. And you have to pick among the rubble when it does that. It's already down just gigantic. Second, some stocks actually do well when rates go up. For instance, this is when you take a look at the banks that came down at the end of the day. They benefit from higher rates. Third, there are plenty of special situations out there with an upcoming event, a catalyst. Eli Lilly with a decision about its Alzheimer's or obesity drugs. Bausch Health, which is breaking itself up into 3 companies. Remember what Joe Papa said? Boeing with a gigantic sale of planes to an airline that had been an Airbus client. Those are special situations. Finally, there are, well, let's think about this. They're minutes, right? They're merely minutes. They're not the actions. After you get a very strong employment number on Friday that shows a big jump in wages, and we were going to get that. After you get a lot of woe is me inflation numbers in the next 2 weeks, it's entirely possible that you might see a peak in inflation because of maybe a peak in Omicron. And that's a contra view that you're going to hear about later in the show, not related to Omicron, but from someone who really knows things well. You never want to go overboard on something as amorphous as the minutes, even when they're as hawkish as they were. If the Nasdaq were up more than 3% this week, then I would be perturbed. But down 3.5%? Or how about, Jesus, down almost 7 since the year began? Somebody got it right to sell, but how long can they stay right? When they toss these high-quality babies out with the stinky bathwater that the investment bankers have been pumping out for the last 18 months, that's an opportunity to buy, not sell. The quality companies, don't come to me with, don't rent the lemonade. You know what I mean? Like, don't do that to me. Yeah, don't tell me I got to go buy some of the reels and stuff. I know, man. Get real, will you? Bottom line, let me put it this way. If you buy here, you certainly aren't buying at the top, are you? You're about as far away as you can be without going into a vicious bear market, which I think is unlikely. Get real.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.